If you're going to buy a house during this market where rates are continuing to climb and the housing market itself hasn't actually pulled back all the way yet, be very careful. There are lots of different mortgage strategies that are coming out. It reminds me a lot of 2008 stuff. So let's talk about it. Hey, it's Eric with Jazz Wealth Managers. We haven't met. What we do here is invest your dough, but on YouTube, we like to educate you about your dough. So today, let's talk a little bit about mortgages, buying a house, because right now, everything is changing. As the Fed continues to raise rates, that ends up meaning oftentimes that the mortgage rate does go up as well. I'll show you some charts on this in just a sec, but let's talk about this because there's some different strategies that are coming into play right now that, as I said, it really starting to remind me of 2008. So you've got some of the mortgage lenders that are doing things called 2-to-1 buybacks. So basically what they're going to do is give you a 2-year rate that is going to be, a lower rate than the general average mortgage rate. That's great, right? So you're going to have a lower rate to go buy your house. It's going to make it more affordable for you. And now you're going to go and get into this house. And then a couple years down the road, there's a good possibility if rates do not come back down, then you're going to be stuck. 2008, it happened. I bought my first house April 2008, by the way. So it's not something that I didn't not see. I saw all of this going on. I had friends who lost houses. And you have to be very careful when you're buying a house. I'm going to tell you this, and I'm going to go into a lot of detail and show you exactly what I'm talking about. So stay with me on this. But the idea here is if you go to buy a house today, you need to buy it based on the current rate and the current price of that house and make sure that it's in your budget. Because if you are going into this house and you are only buying it with hopes that the rates will come down, there's a chance that they won't. And let me show you exactly what I'm talking about here. So right here is the 30-year mortgage rate. This is the average rate. Currently, where we sit today is about 6.92%. If you're looking here, though, in 2008, roughly, when everything happened with the global market crisis, the rates started to come down quite a bit and have been down since. But historically, going all the way back to the 1980s, this was a crazy time here where it really jumped up. But in general, though, what I'm wanting to show you is that we're not far off from, a pretty normal rate based on the 2000s. We're actually a little behind if we're looking at the early 2000s. That being said, if you're buying a house and they're selling you on, hey, you know what, the government's going to eventually lower the rates back down. What if they don't? And you put yourself in a position where you are sacrificing everything to get into this house and you were accounting for your mortgage being a certain price. And now it's going to go up because in 2 years, your rate basically what they call balloons or goes up. It's a dangerous game to play. I'm going to show you right here another one. What we're looking at here, I said another one. What we're looking at right here is the Fed fund rate in orange versus the mortgage rates. So in general, yes, it correlates, as you could say. So it's going to, as the Fed fund rate goes up, so does the mortgage rate. At times, though, that's not the case. If we're looking right here at this little hump here in roughly 2006, 2007 years, the rates did not go up with the Fed fund rate. Now, if you're to really break this down and to understand how all this works, the Fed raises rates. They do this to combat an economy that's rolling away. As in a time like today, we're looking at inflation that is continuing to rise. The Fed raises rates to combat that and really slow the economy. They go to pump the brakes on the economy. Well, what ends up happening is the Fed rate is the rate that banks use to borrow money back and forth, shift money between banks. Well, if that rate goes up and their expenses go up, then the mortgage rate oftentimes follows behind that, because if they're having an extra cost, they're going to pass that down to the consumer, you and I, when we go to get our mortgage. And so we have to be very careful, because if the Fed continues to raise this rate for the next couple of years and you're set to then, hopefully, refinance or whatever the case is in 2 years, and the Fed rate hasn't come down and mortgage rates haven't come down, you're going to be stuck. So I say all that to say, be very careful. There's a lot of strategies that are coming out when it comes to mortgages. And this is some stuff that you really got to think through. And, this is kind of stuff we talk with our clients about here at Jazz, because it's a big deal. It's not something that you should make a decision on just based on a mortgage lender trying to make a quick commission. Nothing against you mortgage lenders. But thanks for watching. If you want to watch more FinTips videos, click here. Be sure to like and subscribe also.